Are you prepared for the CPI print tomorrow morning? On one hand, we know that energy prices actually rose in the month of June, but we also know that services PMIs saw a meaningful downtick for the first time in a while. It wouldn't be crazy to see a neutral read based on that. With prices sitting at new all-time highs in the S&P 500 index, it would seem like there are two paths for downside and only one path for continued upside. Welcome to the Trade Brigade Midweek Market Update. My name is Matt, and I want to show you the pathing I'll be looking for. That way you'll also be prepared. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. We'll kick things off here with a closer look at the SPY daily time frame chart and evaluate what we see from a trend point of view. Of course, we have lows, soft higher lows, higher lows, and along the way highs, higher highs, equal highs, and of course, we're sitting on a brand new all-time high here. We've closed at the highs of today's individual trading range. We've closed at the upper edge of the weekly expected move. This is totally bulls on parade on the daily time frame chart. If we think about the activity from the Monday and Tuesday session, it was really nothing more than a 2-day consolidation, a 2-day balance, if you will. And you could go even further than that and say, on Monday, the sellers tried to move into the Friday range, but there was very little acceptance in that Friday range, and we clearly closed back above. So if I'm trying to evaluate what types of participants are getting involved in this market, it's certainly not stronger sellers. There's no momentum selling here. And there's also not a whole lot of profit taking. If there was, I would have imagined that Monday's move back into the Friday range could have yielded a little bit deeper of a pullback. Nothing that would have jeopardized the trend, but certainly a retest to the top end of the balance range from down here would not have been unreasonable at 549.50. It just simply didn't take place. And as we just sort of recapped, the markets continued to close at new all-time highs here. So there's not much to discuss on the daily time frame other than we're looking for continuation. There's the possibility of a weekly target way up here at 570. If inflation totally knocks it out of the park, CPI is just stellar, maybe it's in play, but let's not be overly optimistic. And even if we do pull back, I mean, there's no indication of a pullback looking imminent, but again, we'll give the benefit of the doubt to the CPI. Let's just say it throws a wrench in the mix here. There's definitely an opportunity for a very, very shallow daily high or low off the top end of the 2-day balance range. And heck, even if we move into the 2-day balance and threaten some sort of hourly head and shoulders, we'll get to that in just a second, and there's some sort of breakdown to here, I'm still highly attentive to the possibility of a daily higher low on the retest of the top of the range at 549.50. So with that sort of easy coverage on the daily, let's just move directly to the hourly and start to get into the pathing and the specific scenarios surrounding the CPI. I mean, again, we'll start from scratch here. What's the trend on the hourly chart? It's definitely got to be up. You've got lows, soft higher lows, more meaningful higher lows. And along the way, it's just highs, higher highs, brand new all-time highs. So can the hourly trend also afford a meaningful pullback to search for an hourly higher low? The answer is yes. Now, you might be wondering what this yellow dotted line is here, and that's a spike that was actually produced on today's session. That's a market profile term. We'll talk about that when we get to the profile in just a moment, but it's going to inform some of our trading decisions around CPI. So let's lay the groundwork. We know that dip buyers are here. We know that momentum breakout buyers are here. We know that stronger sellers are not here. So if the market's going to continue in the upward direction, I really think that you have to see a knock it out of the park style CPI print. If today represented trying to get in ahead of the release, then I would want to see really good news to be what it takes to propel this up and over the upper bound of the weekly expected move with behind us a non-stop breakout from the bottom end of the range to brand new all-time highs. So if we get a really awesome CPI print, meaning something that's possibly deflationary month over month, and then the year over year reads on core and non-core both beat the expectations, it's 3.1 and 3.4. If we can beat those expectations, then sure, the market likely opens on some sort of gap up, and here's the framework that I would use to trade this gap up. And this ties directly into the spike, which again is why I mentioned that in the first place. So opening on this gap up, I think upside really speaks for itself. You've just got to look for your first higher low pullback, either over the overnight high or over an upward sloping VWAP intraday. That way you can at least manage your risk. Very straightforward style stuff. If the market pulls back from the gap, we would call that a gap fade, right? We're looking for a gap fill reversal over the previous high of day. So that might look something like a 5-minute double bottom, 15-minute hammer candle down here. And that's well and good, but I would not be very strict with the market in terms of saying it's got to hold the previous high of day. Because we have an M period spike out of the market, and we'll see that on the profile once again in just a second, if we support over the prior high of day, awesome. But if we go deeper into the range, not very deep, but just to this level, which is 560.25, by the way, and support over that level, something I would be highly interested in, as you guys know we've been using this term recently, the Brigade Bolt, aka a higher low double bottom back over and outside of today's Wednesday range. If we can see that, and the high is basically the upper edge of the weekly expected move, $1 higher than the spike base at 561.25, if we could see that, I would look to be long here, aiming for whatever the overnight high is, and then possibly blue sky continuation after that. So that's how I would trade this in the upward direction if we get a killer read out of CPI. If we get a CPI print that's neutral to lackluster, heck, maybe inflation's actually rebounding a little bit. Let's say that we missed the expectations on the month over month and the year over years just kind of come in line or maybe a tenth of a percentage point hotter. That to me would probably yield some sort of move in the downward direction, opening further inside of the range from today. And if it's a really bad print, some sort of open inside of the 2-day balance range that we were just describing on the daily time frame. You can see that clear as day, not to overuse that word, right here on the hourly. So any kind of open back inside of this range to me then sets up the opportunity for what? Now you have a bunch of disappointed longs from today's breakout session. If they didn't already take profit, and where's your flush? It's underneath Monday's low to achieve that daily pullback we were just referring to into 549.50. So if it's a disastrous CPI, if the print comes in, way hotter than the expectations, I would sort of be looking for a gap down, consolidation in here, and then this break and lower high underneath 554.50 could bring you into a target to retest the top end of the daily balance, which once again is down here at 549.50. Not unreasonable if the print is totally hot and oh my goodness, inflation's rebounding. We know that it's just things are getting out of control. Jerome Powell can't seem to get things under wraps. That's your sort of Armageddon situation. Now again, if we're thinking about both contributors that we can sort of see as data points, crude prices were aggressively higher in the month of June. If we sort of remember back to our PMIs, the services PMI printed for the first time underneath 50 in a long while. So understanding that, again, just CPI can do whatever it wants to do. I'm not trying to predict this with a crystal ball. We'll simply react to whatever the situation is tomorrow. But if I had to make an educated guess, it wouldn't be unreasonable for CPI to be somewhat neutral, therefore giving us either a small gap up, a sort of open up here towards the highs of today's range. The one neutral component would be opening underneath the spike from today's afternoon session on a neutral CPI print. So not Armageddon, not inflation's coming back, out of control, but a neutral-ish to maybe slightly hot on the month-over-month reads that opens underneath the spike base would just sort of, in my view, set up the opportunity for a rejection of that spike, and I would look to be a pullback long on this retest of the low of day from today, closer to 556.90. We've got to be pretty precise with that one, representing the highs of that Tuesday session, right? And also just the lows of today. So once again, your situations for tomorrow really revolve around a really positive CPI, and I know I'm repeating myself a little bit here, but I want to be clear. Any gap and go is straightforward. Higher lows over an upward sloping VWAP, higher lows over an overnight high. That takes care of itself. If we open on a gap up and go for a gap close, we'll give it some wiggle room. We're willing to entertain the Brigade Bolt if it tests the base of the spike and stays over 560.25. If we open in range on some pretty neutral reads, I would be looking for the pullback, and I would look to enter longs on the retest of this breakout point here, giving longs late to the party a second opportunity to potentially get on board of a continued move in the upward direction. Any sort of detrimental read out of CPI opening either, very close to the lows and then some sort of move that gets us this, anything that opens on a gap down inside of the 2-day balance range here, I think it's pretty clear that this is a situation we're willing to entertain, simply noting that this back here, in terms of volume commitment at price, is very, very thin. There's really not a lot of market structure in that particular area. The big daily retest, 549.50. We've been very, very clear about these things. What do we have in terms of confluence coming in from the Monday session of last week? That's basically the bottom of the move up to the highs. You can see that the 38.2, I can't make this stuff up. It's literally the market structure in front of us. The 38.2 is the bottom end of the 2-day balance range. It's the Monday low of day. So great confluence out of that level. If you drop it, not unreasonable for a move into the 61.8. And again, can't make this stuff up. What's that confluence with? It's the 549.50 level, right? So right on the money with the Fibonacci's. If we take out the intraday anchored view apps, any confluence from this point of view, not really. I mean, if you do start to see this breakdown, if there's an aggressive, oh my goodness, inflation's printing back at, I'm certainly stretching the imagination here, 4% on the core year over year, yeah, I mean, maybe there's a test of this and like it blows right through it, but I wouldn't weigh this anchored view app too heavily, kind of in no man's land in between our two key components that we've described so far on the S&P. Let's jump on over to the market internals. If you're not familiar with this screen, this is always Exhibit A. If you're, again, not familiar, check out the video tutorial in the top right-hand corner. What do we see at the exchange level? How's the participation, namely, on today's breakout? Because as we know on Friday of last week, there was a sort of substantial move to the upside, but the market internals didn't really support that volume flow wise, advanced decline wise, and also on the cumulative tick. But if we look at what happened on today's session, I mean, we were not all the way there at 300 million. I'm not going to, falsify the data, but it was definitely much stronger than what we saw on Friday of last week. That does strike me as a bullish indication. During the consolidation, also very neutral, tangled up near the zero line. If we look at the advanced decline line today, meaningfully above the zero line, not all the way in trend higher zone, but certainly helpful to support the bull case and the move higher. The index score, which is perhaps more meaningful, also built out a more substantial read to the upside than what we saw on the Friday session as well, right? You didn't really see a sustained move. You see how some of these ticks in here are slightly lower. Today, I would argue, across the data points that matter, the heavy-weighted data points, you were getting participation. In terms of the cumulative build down below in the tick as well, you are getting a positive build, much more positive, obviously, than Friday's benign downside read, but I wouldn't call this like knocked it out of the park, insanely bullish, oh my goodness, it's time to rock and roll at all-time highs. You really would have wanted to see something along the lines of 5,000 by the end of the day. We simply didn't make it there. So is it the end of the world? Should a pullback be the first thing on our minds? Oh my goodness, I can't believe in this move to the upside. No, this is much more supportive of the move to the upside than what we saw on the Friday session of last week, which once again was a holiday week. If we check in on the market profile, this is where the spike becomes abundantly clear. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. This M period thing that's sticking up like a sore thumb is your spike. That's what we were just referring to on the S&P 500 cash ETF at 560.25, if I'm recalling properly. So if we open over the spike, in the spike, and have the opportunity to use the base of the spike as support, this is exactly why we're using that as an indication. You can see that there was some volume commitment near the highs, but generally speaking, the market only stopped auctioning higher simply because the bell rang at 4 p.m., right? We closed at the high of day, basically. So we don't know whether or not these prices are going to be deemed fair. Opening on a gap up, pulling back, supporting over this to give you the ES futures level. I would use something like 56.75. We'll talk about it more explicitly tomorrow morning with, of course, the pre-market prep. Will be live at 8 o'clock. I hope to see you there. Again, as long as that's holding up, I would not be bearish in the ES. One of the things that I will also point out is that it's a double distribution with the point of control remaining contained in the lower portion. So what does this tell us about the sort of location of participants in this market? Well, certainly the point of control did not migrate higher to what would have been this area right here, and therefore the most transactions took place actually towards the opening consolidation, if you will. So people are holding positions from a really advantageous spot. It's not like we have this top-heavy profile that built out something like this, and then volume at price really dwindled towards the lows, and everybody's trapped up here near these highs. It's actually the inverse of that. So again, this pullback situation that I was talking about, even on a mild CPI read that opens in range, pulls back to the two-day high, basically Tuesday and Monday from back here, I would be looking for these dip buyers to step up again, momentum buyers to preserve their positions with that point of control left lower in the session. One of the things you could also look for if the pullback is the play is notice that we have a poor low on today's session. A and D period are back-to-back, flat across the bottom. This is the improper end of the auction. So opening in range to pull back and sweep that low that then comes back above the Monday and Tuesday high, above the low from today's session, that would be a bullish Brigade bolt off the lows instead of up at the highs that I would also look to participate in back in the upward direction. Your target would be back to the opening print, and then of course you'd start aiming for high of day, all-time high, and so on and so forth. You'd walk your targets up, right? So based on everything I can see right now, I do think that there are two paths for downside, meaning a neutral CPI print that's not very impressive, or a hot CPI print that nobody wants to see. In that case, yes, these traders will be stuck as overhead supply on a gap down, and breaking down below your Monday low of day at 56.15 opens the door for lower. As we know, 5600 is kind of that threshold as well. If we snap that, there's much deeper room to fall into 5580 is the top of the range from your ES futures perspective. To the upside, it's got to be a killer CPI print. If so, great, we open on a gap up. We have our situations outlined, Brigade Bolt or gap and go with some sort of higher low over an upward sloping VWAP or the overnight high. Changing gears to the QQQ NASDAQ 100 on the daily time frame chart, a ton of overlap here with the S&P 500, so we can probably expedite things. Of course, we're in an uptrend. We're sitting at a brand new all-time high, strong close at the top of the daily range. And if we're thinking about the Monday and Tuesday session, two-day balance with a lack of any price acceptance inside of the Friday range on a very high level, just like the S&P. No stronger sellers, no stronger profit taking. We definitely have momentum buyers in control with dip buyers stepping up behind them. If we're thinking about a possible upper target on the daily time frame, really weekly time frame as well, there is the weekly bull flag expected move up here at 518. A little bit of a stretch, but with CPI, hey, let's not hold our breaths there. And on the downside, your major daily level to focus on would be the sustained hold of 486.75, the lower edge of this week's expected move, the top end of the balance range from back here. Any daily higher low pullback that looks like this is certainly enticing for pullback long opportunities if we were to get there in the first place. So let's take it on down to the hourly time frame chart and really evaluate what's going on here, just like the S&P 500. Strong hourly uptrend. Of course, it's just going to be a rinse and repeat of the CPI situations as well. Really strong beat out of CPI, expecting a gap up. We don't have a spike out of the QQQ NASDAQ or the NQ futures for that matter. We'll see it on the market profile in just a moment. So a gap up that yields a gap fill reversal really does want to stay outside of the entire Wednesday range. If we could do so, that would really be staying over the 503.50 level. If so, that of course is bullish. You could also get a gap up and then your first higher low pullback over an upward sloping VWAP to manage risk intraday if you're looking for that long. That's once again on a strong CPI beat. If you miss or come in neutral on CPI, any opens inside the midpoint of today's range, I would start to think about 500 as a psychological area of support and the opportunity for dip buyers to really step up there. That would really be more so a situation if we have that neutral CPI print. If we have a hot CPI print, I'd be thinking about breakdowns underneath 500 for something that maybe offers a 5 or 15 minute lower high here that then gets to the bottom end of this range, and that's going to be your Monday low basically at 495.50. If you get a stronger rally off of that, what's the pattern that starts to emerge? I don't think we classified it by name over in the S&P 500, but the same concept really applies. It's just a head and shoulders, and then underneath your neckline is how you achieve the deeper daily pullback into that key level we were just describing at 486.75. So just to name the levels one more time, 500 underneath, that's where your sort of right shoulder wants to build out if you're bearish on the market right now. Your neckline flush is underneath 495.50, and your stronger downside target on the daily is 486.75. I want to be very clear that if we do get a deeper pullback towards this area, I'm definitely thinking about longs because the risk reward there is more advantageous to the upside, right? We're trying to exploit a daily trend in the upward direction. If you could pick off an entry here with a stop below and basically try to navigate back up towards the all-time high, there's an asymmetric risk reward opportunity there. And it doesn't have to be a swing trade where you enter, long calls here and try to aim for this over time. But generally, I would have more of a bullish bias when we're coming into a possible daily higher low pullback zone, right? Back down to the hourly time frame chart. If we do open on a little bit more of a meaningful gap down, keep in mind today's low of day out of the QQQ was actually inside of the Tuesday range, a little bit more meaningfully so than the S&P 500. So if we open on a gap down and then flush for something that does this, I wouldn't really push my luck all the way to here on the first go around. I would more so start to think, all right, this intermediate target can at least provide a bump in the road. If we build a daily, or sorry, not daily, but intraday rather, bear flag, then continuation perhaps into Friday could be likely into that 486.75, this intermediate zone, which probably deserves being grayed out just a little bit. If we do something that looks like this, make that a little bit more dim, is at 491.25, just simply representing the top of the Wednesday half-day session, right? So that's your QQQ. We know our ups from downs. We know what we're looking for based on CPI as well. We'll just do a double check with our Fibonacci's coming from the bottom of the move up to the top of the move. You're not getting as clean of confluence with the 38.2, but the 61.8 line in the sand is definitely reinforcing the idea about the daily higher low at that 486.75. And then we'll quickly check in on the anchored VWAPs also. Again, not a ton of confluence out of these. Maybe over time, I'm talking about like maybe by Friday or even early next week, you get confluence out of this anchored view app at the 486.75, but that's kind of a stretch as we move into Thursday and Friday. Let's check in on the market internals for the NASDAQ side of things. And just like the S&P 500, more meaningful inflows today. The advanced decline line was more positive versus what we had last Friday. And you also saw a stronger cumulative build in the upward direction versus the more bearish build on Friday of last week. Now, once again, this is not to argue that these are the best reads out of the cumulative build. We did not see over substantial volume inflows on a meaningful reversal back to the upside. And we also weren't in trend higher zone. So, I mean, take it for what it's worth. It's more bullish than Friday's move higher, but it's still not like everything's firing on all cylinders, and that shouldn't really be much of a shocker at this point. We know that the market's been somewhat bifurcated into, the haves and the have-nots, meaning the heavily market cap weighted components versus everything else, basically. If we quickly check in, and this is not to say that, oh my goodness, Matt said that this doesn't confirm the breakout. That's not what I'm trying to get at. I'm just trying to, provide some context around the underpinnings of this move from today's session. Definitely more confident in that than what we had last Friday. And here is the market profile. So sure, we have a little bit of excess in that M period. I wouldn't go out on a limb and classify that as a spike. More importantly, we do have a double distribution out of the NQ futures, which you can see is sort of in this zone right here. If there's consolidation in the upper zone, great. That's bullish consolidation if we open in range. If we open on a gap up and we're unable, or I shouldn't even say we, because I don't necessarily know that I sort of want to align myself with them before the time is right, I should say the sellers are not necessarily strong if we remain in the upper distribution of today's breakout. You'll also notice that unlike the S&P 500, the point of control did migrate higher. So I would start to think about shorts if there's a breakdown underneath 2840. That's not 2840, that's 2840 in the NQ futures to get through some of the single prints and basically a retest of the of the Tuesday high of day here, which is closer to 2780 there. If I just quickly flip back on over to the QQQ, I do want to give you some indication of where those single prints would be out of the cash market. Let's bring this over to a 30-minute time frame chart, and let's see what we can sort of see over here. So your 30-minute single prints would exist sort of over $500.64, yet below $501.62. So use this as a little bit of your zone here for those singles. If you're consolidating above, it's bulls technically still in control. If you start to dip a toe underneath, I wouldn't be afraid of sort of looking for something that looks like this, especially if paired with one of those CPI prints that is either neutral or a hot CPI print. You're probably going to open underneath that upper distribution anyways. And last but not least, we have the Rusty Russell IWM Russell 2000 small caps on the daily time frame chart. And man, is it rusty. It's just totally out of practice. You tell me, what's the trend in this box? I certainly can't spot one myself. Maybe the longer run daily trend is trying to remain in the downward direction, but yet we also kind of have an attempt here for some sort of higher low. If anything, I would really lean on the idea that this is probably more so weekly range compression than anything else. So we're getting close to the apex. It doesn't guarantee a break in either possible direction, but with CPI as a catalyst, it wouldn't be a shocker to see this attempt to get out of the range either here or over here. So we'll sort of give this one the wait and see. There's not much of an edge to discern prior to the CPI number. I mean, the trend is completely neutral. The 50 SMA is almost completely flattened out. You've got some key levels to maybe pay attention to, but that's really it. This strikes me as the dominant balance range recently, at least. And if we're over 203.25, great. Bullish pressure for the S&P 500. If we're underneath $200, we know that that also jeopardizes the weekly line in the sand and possibly threatens, if we just quickly go to the weekly time frame chart, that the head and shoulders is back in play as something that ultimately maybe just has like a second portion of its right shoulder to come back down to the neckline. So concerned about that 200 level on the daily time frame chart. But once again, in terms of indications to take away from the daily, there's nothing going on here. There's a lack of acceptance higher. There's a lack of sort of range expansion to the downside either from the sellers at this given point. Now, if we're just taking the most recent data, of course, today's daily bar is a little bit more bullish than bearish. I mean, it's closed towards the high end of the overall range. Contrarians would say, great, that's an opportunity for mean reversion. We're just trading a box, Matt. It's going to come back down to the midpoint. I suppose, but with CPI as a catalyst, I wouldn't count out the opportunity that a really strong beat on CPI probably propels this up and over the top end of the balance range. On the hourly chart, again, you can just see the madness back and forth. It tries to gap up. Here's one caveat that I would say is probably worth remembering, right, as we're trying to navigate this. the buyers had an opportunity here for an ideal higher low. We even gapped up back closer to the opening print of the Friday session on the Monday session of the shortened holiday week. Was there a higher low above the range? The answer is no. And you can see when we finally poked above, it was immediately wiped away with a really weak print on Friday versus the broad market, meaning the S&P and NASDAQ, which were certainly much, much stronger. And then as we're sort of getting the two-day balance out of the S&P and the NASDAQ, what does the Russell do? It just goes wall to wall in its little balance range. So, I'm not necessarily thrilled with any of the action here. I don't think it's worth reading into. So for that reason, we're just going to sort of leave it at that and say over 203.25, bullish pressure for the S&P, underneath $200 flat, bearish pressure for the S&P. Really no reason to try to dissect it any further than that. If we're looking at the internals for the Russell side, kind of the market, you had volume inflows that were more substantial than maybe flat, but nothing crazy today, not up near 125 million, nowhere close to 300 million. That's something like your S&P or the NYSE really trades on an average basis on a substantial day. So nothing to write home about. Sporadic out of the advanced decline line here, and here. I mean, you're, again, technically green on today's session, but nothing to write home about. And the same thing out of the cumulative tick. There's just nothing to talk about here. So until we can actually get out of the balance range, I don't think that this is something to spend, an exorbitant amount of time on. Here is the Russell market profile. And I suppose one of the things you could take away is that the end of day move is a spike technically, and there's a ton of volume that transacted up here at the highs. So any sort of pre-market move that does not sustain either a gap up or some sort of open inside of that point of control. So if the CPI is not really a great read tomorrow, the risk of this turning into overhead supply and just a rotation to the bottom end of the range would seemingly be higher. And this is just, purely based on position analysis, not necessarily sentiment analysis, right? So that's really it out of the Russell. Keep it simple. Watch for those big levels. So if the Russell is nice and boring, let's see if we can spice things up with some more supporting evidence, beginning with the weekly performance of the S&P sectors. Leading the pack is not necessarily a sector, but just these semiconductors. They continue to act as a market leader as we're breaking out to continuous brand new all-time highs. That, of course, is a bullish indication. Just below is the XLK, the heaviest weight risk on sector for the broad market, up 1.73% on the day, followed by consumer discretionary, and then utilities as well, actually performing quite well, up 1.25%. That's actually a lighter weight D for defensive sector, but not the end of the world. Upward pressure is still upward pressure, and the true leaders are where it counts. If we're looking at the bottom end of the barrel, the red sectors are going to be the energy sector, the consumer staples sector, and the communications sector. Communications are really about flat on the week, only down one basis point there. It's negligible at best. I really don't see any reason to be bearish the market if the sectors across the board really are not suffering in any big way. There's no reason to be overly contrarian saying, oh my goodness, there's a lack of participation. It's only 3 names. It's 7 names. It's the Magnificent 7, the Fantastic 4, whatever you want to call them. I mean, yes, there is a market cap and weighting issue, and it's not even an issue. The index was designed to be this way, right? So I wouldn't call it an issue. People are sort of attributing it to becoming an issue and a risk, and yeah, maybe there's some threat to it, but for now, you are seeing participation in the upward direction. So at a sector level, I don't really see the big threat for, oh my goodness, this daily uptrend is going to fail. Look out below, 2008 style recession. I'm not seeing it. If we look at the semiconductors, brand new all-time high today, up obviously big time on the week, all set. I mean, this easily has the opportunity to compress into some sort of like ascending triangle at this point. If it does pull back, there's no indication of a pullback looking imminent, and any further extension in the upward direction would just leave more opportunity for a daily higher low. So any reason to be bearish here? The answer is no. If we look at the XLK tech sector, it's the exact same thing, but probably the extension already stacked on top, right? Now there's just an opportunity for a higher low here, there's an opportunity for a higher low here, and the trend remains in the upward direction. No issues out of the tech sector. The XLY, brand new highs, coming into a known area of resistance. Is it possible that this pulls back? Yes. Is that healthy for the market? Yes. Two-sided trade is great. Look for a higher low anywhere over 185.15. No issues there. XLU, a little bit of a rebound off of this low. If I'm just thinking about its relative strength to the broad market, it's not even close to making a new swing high as the market's printing brand new all-time highs. So is there a posture issue here? The answer is also no. I'm not seeing the evidence so far that would suggest, markets, oh my goodness, don't trust this rally. It's got to be this big breakdown. Oh my God, duck and cover. Doesn't exist. XLV, and now watch this, right? CPI is going to come in hot, the market's going to gap down, and you're going to say, oh, Matt, this guy's an idiot. Such is the way of the market. It's just comedy at that point. XLV, what do we see? No issues out of this one. Big time opportunity for a weekly higher low. It's building out into an ascending triangle. Any breakouts through the top of this will just be bullish pressure for the broad market. Remember that it's technically a D for defensive sector, but it's also the third heaviest weight sector in the S&P. So if you want to see things broadening out, if you don't just want to see a tech-driven marketplace, then guess what? The XLV breaking out through this is going to be helpful for the broadening sort of thesis. So all set on the structure there. Let's go on over to real estate. It's sideways in this range. Interest rates are coming down slightly back below that 4.33. We'll talk about those in just a moment. So no surprise to be at the top of the balance, but no real breakout yet. XLF, big earnings coming up around the corner Friday. Before the open, we get JP Morgan, Wells Fargo, Citibank, and we'll see if this has what it takes to break out up and over the 42 handle into brand new all-time highs. As of right now, I do like the fact that this is sort of more so following the pattern of an ascending triangle. You could sort of argue that this is maybe an inverted head and shoulders. You're over the neckline. Equal high target is possibly on the table. And instead, right, that is in play, and this is certainly no longer in play. That right shoulder has sort of been decimated by these equal highs and then higher highs on the Tuesday and today's Wednesday session. So all set on financials. I don't really see the big threat here either, unless earnings are just absolutely in the gutter from JP Morgan, which, it's always a tricky thing. I think that the numbers will come in fine from JP Morgan. I don't oftentimes speak on earnings, so this is a rare occasion here. I think the numbers and deal making will be fine. The investment banking segments will be fine out of JP Morgan, but it's just the market's expectations. If the market was expecting more, it was still good, but they were expecting more, the stock can still gap down. So that's, of course, always the risk you run with those types of, more speculative analysis on the numbers and the market's expectation. So anyways, XLB, really lightweight sector. Sure, you've got your weekly double top in play. You're underneath the neckline, a little bit of a retracement. Wouldn't be unreasonable for a lower high to be set here up against 88.65. If that's the case, guess what? It's slight downward pressure, but it's such a lightweight sector, it's not going to break the S&Ps. XLI, this one's a little bit more concerning because it represents about 8%. It's also somewhat more cyclical it represents the cyclical side of the economy. Same thing with materials to some degree. If you were to flush this and make a big new swing low, I would make note of that here out of the XLI. So watching very closely the 120.4 level. TLT, just wanted to bring it up because it's been a wild ride over the past little bit, up and down. It's been stabilizing and it's been underperforming, obviously, the S&P as we move forward. So like this big, this in here was a threat. It was like, wow, flight to safety is really coming out. Not so much anymore as we've stabilized. You're not seeing that continued outperformance. Energy is also, mildly higher on today's session, lower on the week, but nothing to the degree of like, oh my goodness, Armageddon is right around the corner. There's this huge run, and this is basically what we were talking about. Actually, it's more appropriate to look at it through the lens of crude here. As we think about what happened in June, here's crude prices increasing. Now, one of the arguments that maybe someone's making in the comments section, I'll have to check in with you guys, is that, just because the price of crude has actually moved higher does not mean that immediately prices at the pump or, transportation services are going to suffer. There might be some sort of lag associated with this increase in the cost of crude, considering, storage fees and then, the whole nine yards. The business of oil, I'm not a master of it, but wouldn't be unreasonable if there's some sort of, again, lag associated there. So to see the energy sector as a whole slightly lower, over this multi-month time span, maybe that's a combat point if you are a counter argument to what I said in the intro, but just still really remaining, whatever the reaction is at 8:30. It's not like you can trade pre-market names here anyways. Futures traders, sure, but we're just going to respond to the reaction from the market anyways. Moving along, consumer staples doing nothing, sideways in the balance range. Don't diddle in the middle. Don't exchange in the range. Don't enter in the center. I don't know how many times we can really talk about that. So just like the IWM, it's more meaningful when it makes a new pivot swing high. Let's move along to the communication sector. Looks great. Multiple inside bar setup here. It's almost what would that be? A 3-bar play would have been here, 4-bar play, 5-bar play. You've got a 5-bar play setting up with the possibility to break into, new all-time highs over this little shelf on the XLC. This is a heavier weight risk on style sector. And again, even though it's like negligibly down on the week, it's basically flat. It's still setting up a bullish pattern near all-time highs. like, even though it's red, you can't really say that this is a downward force for the marketplace as a whole. If we quickly check in on the ratio grids, if you're not familiar with this setup, first of all, check out the video tutorial in the top right-hand corner. What's going on here? I mean, we have seen continued sort of carrying the market, if you will, from the tech sector. The discretionary sector, with Tesla and Amazon both breaking out, has started to pull its weight up and over the 50 SMA now. So monitoring that to continue its reversal in the upward direction. Ideally, with bank earnings, this sees a nice upshot as well to hopefully at least test the 50 SMA, if not recapture it out of the relative strength line in financials. Industrials, again, cyclical side doesn't really feel so good right now. Communications are more so stable, even though the bullish setup looks good on the daily time frame chart. Not a threat for risk off becoming the new regime, if you will. Same thing over here in utilities. So ratios all set. If we're taking a look at some of the specialized ones, break to new all-time high followed with a new higher high out of this. Same thing over here, finally up and over or at basically these equal highs. This checks out, being bullish for the market down below. And the same thing just continues to ripple through all of the data points. This is risk on, market makes a new high, this makes a new high. Definitely not over this prior swing high, but constructive in the overall direction of the trend, certainly not divergent in the smaller time frames. And you would see the same thing over here, new high out of the SMH versus the XLV. Moving into our dollar, what's going on? We have seen a breakdown over the last little bit. This has not been this week, but into the end of last week. That is sort of one of the meaningful pressures to the upside out of the market there. And we know that gold is also cooperating. If we take a look over at the gold contract, it moved to the top of the range and is now cooling off. If this can spot a higher low and break out, in theory, I would, the dollar expressed as a currency, gold expressed as a currency, I would expect that would be bullish pressure for the equities market down below. If we move along to interest rates, this is sort of what we were talking about being underneath 4.33 on the XLRE for real estate. I mean, there was this move to immediately come back down underneath, just looks like nothing more than, to me, a big time opportunity for a weekly lower high, maybe a daily equal high. And now it's just all about whether or not we can see follow through in the downward direction. I think tomorrow on the CPI, if we get a big beat across the board, you better believe interest rates are going to drop because the Fed's probably not going to hold back about cutting rates sooner rather than later. We haven't gotten any sort of insights from Jerome Powell as he's been navigating his testimony in front of Congress / just government officials. It's political pandering back and forth. The 2-year inverted here is certainly falling over a little bit, consolidating on these lows. Typically, and again, associated with the market environment that we're in right now, this makes total sense, anticipating the couple of cuts that are likely in the pipeline currently. If we take a look at the tracker tool, any big, new breakthroughs over here, the answer is no. Still highly likely that we get a pause in the month of July, and then something like a cut in September is now being priced in as a higher probability outcome. This is something that you could probably take a screenshot of, or at least just continue to check back in on. After CPI, how do these probabilities change? If we get a hot CPI, you better believe that this is going to flip back to a pause in September, and then maybe it's just Kashkari's correct, and we only get one cut into the month of December. So we'll be watching out for that tomorrow morning at 8:30. That's sort of just a heads up as to what to be paying attention to. No major economic events have happened so far this week. The 10-year bond was fine today. You didn't really see a huge discrepancy out of the auction at 1. And, it's just all looking forward to CPI right now. So no major fundamental commentary. We'll update you on Saturday as to how the CPI comes in. If you want to tune in live for the live market reaction at 8 o'clock is when we kick off the show. The release, of course, is at 8:30. We'll actually dive into the CPI report tomorrow and see what the individual components look like, whether or not there are concerns. Was the thesis right about energy deflation coming to an end with the CL moving higher over June? We'll get into all of that stuff. So join us live tomorrow morning, 8 o'clock here on the channel. It is completely free and open to everybody. Trade Brigade, or it's actually technically youtube.com/Trade Brigade/live. Tune in at 8 o'clock. If we move along to the earnings calendar, we alluded to this when we were talking about the financial sector. These guys are going to be your heavy hitters Friday before the open. JP Morgan, Wells Fargo, and Citi. We'll see if they can come in with really strong reads and beat the market's expectations, causing a financial sector gap up. That sort of rotation would be bullish and positive for the broad market as a whole. Let's jump back on over to the platform here and get into our risk appetite. TLT, again, this ratio, we're going to probably start omitting it. It was sort of a concern as it was stabilized and this was taking place. no longer a big deal, so we'll not spend as much time on that going forward unless it does start to change again. Bonds in relationship to themselves are stabilizing here. As long as they're not aggressively trending in the upward direction, this does speak to positive indications out of duration risk down below, so that's still all set. If we take a look at credit spreads, this is flattening out. Remember, we were concerned about sort of this creep, the big decrease here, and this move flattening as well does strike me as bullish indications for the equities market down below. What about the HYG in isolation? There is a divergence here that is bearish. Notice that we have these equal highs instead of the massive higher highs that the markets continuously produce. Now, does this mean go out there and short it? Matt pointed out this one bearish divergence among a sea, not even a sea, an ocean of bullish data points that we've looked at so far. Absolutely not. I would not get out here, and short the S&Ps just because the HYG is divergent. I mean, we can look for those pullbacks, but goodness, this is not an Armageddon situation that is brewing because the HYG is divergent. But continuing to sort of check in on it, Bitcoin is suggesting a lower high underneath $60,970. This is a risk-off rotation, not one-to-one with equities down below. We continue to sort of stamp that on as a disclaimer with the cryptocurrencies, but generally speaking, this does seem like it might. In theory, this Bitcoin and the NASDAQ have moved pretty well in sync over the last little bit. So to see this diverging a little bit does, it's a bit of a head scratcher. Again, just like the HYG, it's not enough to go out there and short the broad market, but making note of it. As we take a look at new highs versus lows, how are we faring on the week? Basically flat, unchanged there. No issues out of breath. It is stable. Similar commentary here out of the SPX A200R. Big pullbacks are not taking place. Mild, smaller pullbacks really aren't all that bad and are on the road to recovery. You'll notice lows, potential higher lows. Really want to spend some more time up and over the 50% mark on the SPX A50. Wow, voice crack. Back to 6th grade for me. Really want to see this improve as we're looking for that continuation into possibly new highs, consolidation up here. One of the things that I've been a proponent for, and I'll continue to be a proponent for, is that the market's likely going to go sideways and the breadth will catch up to the market. I am not a believer that the market is going to heinously see this pullback into these lows from April because breadth is bad. That's just not something that's on my bingo card currently. I'll eat my words if I have to, but I'm a believer that market breadth will catch up to the market, not the inverse of that. The market will catch up to market breadth, meaning a move to the downside. RSP has failed to break down aggressively underneath 163.63. So does that support the thesis that I just outlined? I think the answer is yes. QQQE also breaking to new highs today. Beautiful, makes sense considering the NASDAQ is of course one of those primary drivers. No big concerns out of industrials and transports here. What about volatility? It continues to sort of remain stable out of the VIX itself, but sneaky little suspicion here as we come into the CPI print. So this isn't a shocker because of what tomorrow is, but it's certainly a move higher on today's session. So are people preparing for the possibility of a pullback? The answer is yes. And somewhat ironically, if everybody's sort of hedging their bets with puts, if those puts don't need to be exercised, or generally you don't need them as a hedge, when you close those puts, that will imply upward pressure for the market come tomorrow morning. So, if we get a really strong CPI print, I'm definitely of the mindset that the, gap and go or gap fill reversal off of the base of the spike out of the S&P is a really strong possible path for tomorrow. But it's got to be a strong beat out of the CPI print. So that's your VVIX and the volatility futures. Strong contango, a little bit of a pullback here and an uptick out of the one-day VIX. But once again, we just sort of described why on the VVIX itself. Let's jump back on over to the individual charts. We'll run through the core list of companies and then I'll send you on your way after 3 additional trade ideas. The first up on the chopping block is Microsoft. What do we see here? An inside bar on today's session. A little bit of a pullback round trip to the breakout from Friday of last week. Let's take it down to the hourly so we can see this. Put yourself in the shoes of a seller, right? This is always the easiest thing to do in the market. If you're trying to understand what should happen next, put yourself in the shoes of who just had the upper hand. Big breakdown round trip of this, right? Sellers likely wanted a lower high underneath this area right here, 464.25. Did that happen into the close? The answer is absolutely not. So is it possible that you get a pie in the sky, inverted head and shoulders, and break the blue skies over the neckline, just loosely over that 468.35? I think the answer is yes. So any consolidation up here, this is a higher low. This is bullish consolidation, also suggestive of a hourly higher low, bull flag, if you will. And then we're looking for follow through. To the downside, it would have to turn into, at this point, some sort of descending triangle over time for a break through these lows, more meaningfully getting a lower high underneath, 460.50, and then getting follow through into this retest point at 456. Then simply walking the targets down to the downside, noting that you're still looking for daily higher lows. Let's give ourselves a reality check. This was one day to the downside in the grand scheme of things in a massive overall daily uptrend. Is the market bearish in Microsoft? The answer is no. Apple, what do we see? Same thing. Let's start on the daily, get the context. Huge move to the upside, brand new all-time highs today, breaking out over the equal highs. The upside takes care of itself. I know I sound like a broken record. Brigade Bolt, if we open in range, higher low over the previous high of day, gap fill reversal is a possibility. The only time I would be bearish on Apple, is on a sort of sustained move underneath 224. Why? Because these incremental higher highs just mean that longs late to the party finally got rewarded today. If they're like, oh wow, like hot CPI is really throwing a wrench in the mix, underneath that level, everybody late to the party, initially on the slow grind higher, is going to fold. So under 224, I could really envision the pullback to 219. As of right now, it seems like a lower probability outcome. NVIDIA, the one stock to rule them all, it continues to sort of stair step in the upward direction. I like what I'm seeing. Morning pullback was held over that 133, and the next target's just simply looking for the full rotation into this low, the pullback from the original all-time high before the rebound, right? So that's at 136.25. If we can get there, what's the next phase, right? Some sort of pullback over today's high of day, break up here, and just the stairs continue in the upward direction. CPI can throw a wrench in the mix of things here. If you want it to be more of a bear out of NVIDIA, if you're looking for a reversal out of NVIDIA, I would only change my tone underneath 129.25. Basically, anybody who is looking at this through the lens of double bottom will be disappointed underneath that level. If we're under 129.25, changing tone to being neutral, this is definitely a daily lower high, and then it just becomes a matter of spotting the sort of bearish downtrend in here to capture this thin structure retracement back down towards the lows under 127, targets 122.50. So pretty straightforward out of NVIDIA. I'm not seeing any, the bullish setup up here is also somewhat convoluted. It's not like you want to be long here with limited upside and then a possible pullback. So I'm not saying it's the easiest long up here, but the chart's definitely more bullish than bearish. If we look at Google, it's a lot of the same here. This is just nothing more than a massive bull flag break and higher low attempt into the afternoon. If we can hold over 190.75 blue sky territories, if we're under 190.75, consolidation until proven otherwise. If we fail 189, thin structure retracement, right? Thin structure retracement all day long. I would look to try to participate in a momentum short intraday scalp under 189 into 185.80. Then I would promptly change my tone here, looking for a daily higher low, right? Let's go to the daily chart really quick so we're not losing sight of what's ultimately happening here. This is a long-standing balance. We broke out. Here's another balance. We broke out. If there's a pullback to test the top end of the range, I want to be involved on the long side for a daily higher low. Once again, that level, 185.80. Next up, Amazon. Nancy, how's she doing? We've got ourselves an ascending triangle that broke out. You want to sort of see deja vu? You've got yourself an ascending triangle. Is it going to break out is the key question. Over $200.25, great. I'm all aboard the long train looking for that Brigade Bolt over that level. Any continued consolidation in here is exactly that, neutral, consolidation until proven otherwise. And where do you want to be a short? Not underneath these lows, probably underneath 196.30 for more of that thin structure retracement back here. Notice that you'd be battling, right, trying to short this. You're just trading directly into some of this chop, whereas this breakdown, a little bit more meaningful of a range to rotate through. So that is your Amazon. Let's move along to the metaverse and Zuckerberg's fantasy land over here. The fantasy land is slowly becoming a reality, right? Notice this break higher low above. If you wanted to count this as sort of a double bottom, great. Your next step is the Brigade Bolt over the neckline. So that's at 534. As long as we can hold up over that, the rotation is for the equal high. Daily time frame chart is just building out a very classic and textbook bull flag. If you are going to be short, if you're going to look for shorts in Meta, just like everything else, be patient for the breakdown of this level in here. That's where you're looking for your thin structure retracement and more of that emotional overhead supply to sell off, causing downside pressure. That level, 529.50. Next up, Tesla. What's going on with Mr. Musk and his now back to being rocket ship, no longer the boring company? The grind to the upside's real. One of the things that I would continue to caution about in a name that looks like this after a pretty extended move, right, is sure, the upside can continue, but if you're just getting these incremental higher highs, put yourself in the shoes of a buyer who's long late to the party. Are you happy up here as a buyer long late to the party? You're not being rewarded nearly as much as someone who longed the breakout here, longed the gap up, any of those other long locations. So if there's a sudden liquidation break, if there's an aggressive move to the downside, don't let that throw you off. I think it's just longs late to the party closing out, and then there's going to be a better opportunity for a daily higher low at some point in the future. Now, again, this does not mean prepare for shorts by going all in second mortgage to the house on puts. It just means be aware of that situation being something that can take place, and don't let it surprise you when and if it does. So where would that possibly start to accelerate? I would be concerned underneath this 250.25. If this turns into a double top and we start trading around in here and then flush this, you could start to envision how that maybe turns into, there it is, your very classic and trademarked, by the way, Man Ray pattern, not Manta Ray, Man Ray. That's Tesla. Next up, JP Morgan. This one's going to start to fall onto the back burner because of earnings on Friday before the open. Not really interested in getting IV crushed on this particular name, but the chart is bullish here. Here was our double bottom. We talked about this on the Tuesday morning session today. I like the fight to recapture back above the neckline and holding above as well. So if I had to trade it, someone was forcing me to trade this ahead of earnings, I would maintain more of the bullish stance, noting that bears, if they were in theory stronger, should have yielded this as a failed breakout, lower high under the neckline in here, and then looked for a equal low, if not follow through for your thin structural retracement. Didn't happen. Bullish consolidation into the afternoon, either pullbacks that continue to hold 206.50 or breakouts through 209.50 into blue sky territories. For me, this is probably on the back burner with earnings until next week. Let's take a look at Netflix. What's going on with Netflix? This is more so of a bearish pattern that's definitely in force for tomorrow. Notice that we have a double top, 1 and 2, neckline down here, Brigade bolt for the bear side, building an H pattern. Again, Brigade bolt's more suited to the channel. Let's take a look, right? This is an overall balance range. This is a look above and fail, look above and fail. This lower high kicks off an hourly downtrend. Any sort of flushes underneath 670, 375, looking for the equal low to complete the look above and fail. Always target the opposing end of the balance. That would be here at 663.75. Last but not least, AMD, which has been on fire recently. And we had sort of talked about this, right? We were comparing AMD to Tesla with the long-standing consolidation finally breaking out over here. Strong move off of the open. One of the things I find very interesting about AMD, let's actually go to a daily chart so we can see this, is back here there's a very known shelf of resistance prior to these couple of highs from back here. I just want you to understand where that's sort of coming from. Maybe even on the hourly chart we can see that, yeah? Here we go. So notice the rejection, all these different rejections. It's only a couple of, gap up open and then a random upper wick up here that really caused 187.25 to be a rejection point. So if we go to the recent price action from today's session, we did technically top tick the upper wicks of that area, but notice that there was an attempt to get back down underneath the bulk of the sell side resistance at 183.15. So this is one of those small nuances that I think is worth paying attention to. If we're over 183.15, I would be like bullish consolidation, show me the Brigade bolt over 187.25 and we'll continue this break in the upward direction. If we fail 183.15 and we're more so underneath, I wouldn't say I want to short the thing into the ground, but I might have second thoughts about a possible pullback or trying to long it so early up against 178 on the initial retest. Now, it's not to say that this isn't a possible area of support. It is, but under 183.15, this is looking like the end of the rope in terms of a euphoric break in the upward direction. All right, we already talked about crude when it came to the energy sector. Let's get into those 3 additional trade ideas. They're going to be, on all the names, AVGO. Let's talk about Broadcom first, and then we'll move through the rest. What do I like about this? It's a multiple inside bar setup. Notice that you have all these flat highs. If there's going to be some sort of pre-split euphoric move, again, let's say that CPI comes in better than the expectations, great. Looking for this equal high over time. That's a breakout over 1755 into 1840 out of AVGO. It's in play as long as it holds over 712. Consolidating here, Brigade bolt off to the races upside. Not interested if we're underneath 712 or 1712. Noting that we would be falling back down underneath the midpoint of this balance range, and it's, I would tend to think more so about a lower high opportunity if the CPI print comes in hot and, everybody's sort of discouraged about the market. Another one in the semiconductor space, let's move on over to MU Micron. What's going on with MU? Earnings in the rearview mirror, great. This as a possible double bottom is what captures my attention over the daily 50 SMA. That's the blue moving average on my screen always. Let's take a look at the hourly time frame. Pretty straightforward, right? Just nice rounded bottom, a little bit of a, a little choppier on the second part of the double bottom there. But regardless, any sort of clearance up and over, I would argue, 138.25, and this thing's off to the races targeting Can't see, can't read. 142.75, and then beyond that, you're talking about being very, very close to all-time highs in that euphoric sort of secondary leg here after the breakout. So looking to see if, in the grand scheme of things, we can get a major Brigade bolt, something that looks like this, then rotating up here to these highs at 160 loosely. I know it's a little bit shy, but generally speaking, that's the concept out of the MU chart, right? Next up, we've got something different. It's totally unrelated, but PepsiCo does release before the open tomorrow. So keep that in mind as a possible sympathy play. But the reason this hit the scanner and sort of won a position here in the video is because you've got this clear sort of trend over the 50 SMA. I know we slipped it a little bit here, but this flat top also building out around 64. If this can hold as a higher low, I like the fact that we looked underneath the Tuesday low so deeply, yet closed inside of the Tuesday range over the opening print. Just a very classic indication from a hammer candle, right? So if we can take out the 50 SMA, if we can recapture that, trying to aim back up here at 64, a little bit cheaper of a price point compared to those other two names that we were just talking about. It's unrelated to the semiconductor space. So if you're looking for something that has like sort of an uncorrelated return with that specific sector, maybe this is the idea for you. Anyways, that's what I've got for you in today's episode of the Midweek Market Update. Once again, we will be live tomorrow morning at 8 o'clock for the pre-market prep, coffee and donuts on me for the CPI Consumer Price Index release. Inflation reads at 8:30. We'll see it in live time. We'll break down the report. We'll see where the inflation is, where it's not, if we're improving, if we're sort of accelerating again and things are heating up. We'll talk about it all. So I'll see you there tomorrow morning. 8 o'clock is when we'll kick off. And with that said, I wish you all a green trading week. We'll catch you in the next one.